Alright, okay, good evening everyone. Hey, welcome to today's session. What I'll be doing over here very quickly to give you an overview, some housekeeping, and then we'll get into the markets and share with you some opportunities and trade setups and ideas for the week itself, okay? First thing first, before I begin, I'll be very quickly spending about 10 minutes sharing with you the trading framework as well as the strategy and setup. So as we talk about the trade signals later or ideas, at least you are familiar with some of the principles and techniques, right? And of course, if you pay attention today, you can actually take this and apply it into your own trading after today's session. Okay. So what you see on the screen right now is basically what we call the DSC framework, and essentially that's the approach that I use to trade the market, right? So the DSC framework is basically a three-step process. Okay, very quickly covering on this. First step is about establishing your directional bias, right? So that's the D element in it. You need to have a method to identify whether you want to be focusing on a buy or to sell, or if the market isn't very clear, you just want to stay out of it. Okay. Now, once you have a directional bias, then the next thing is to look for a setup. Right? What are the conditions? What are the criteria? Where is your entry? Where's your exit? Take profit, stop loss, things like that. Okay, and that's what we call the setup phase, aka a lot of traders would call that strategy. And then the third part on this framework, which is the context, right? The C element, is to really understand on the higher time frame perspective. Is there alignment in terms of the context of the trade? Are you taking a retracement counter trend? Are you looking at following the big picture direction, following the trend in terms of your setups and your trades, right? So as we go through today's session, talking about the opportunities that you can keep an eye on, these are some of the principles that we'll always come back and touch on. Okay. Now, obviously, is if you're fairly new to the DSC framework, you're fairly new to some of the strategies that I'm going to be using to trade. You might have questions, right? And I will do my very best to answer as many questions as possible. Just feel free to put it into the chat. On YouTube, you can put it into the live chat. When I take a look at the questions, I'll then be able to answer questions, right? And of course, I'll be jumping straight into some of the trade signals or opportunities available. I won't be going through the entire market because there's a lot, and there might not be sufficient time, right? So we'll dive straight into what's worthy to be paying attention, right, or what we call the watch list. But of course, if you have some instruments that you'd like me to talk about, feel free to just put it in, and then I'll be able to kind of like look at the market, talk about it, on the spot. Okay. So this is the DSC framework. Very quickly, I also want to share with you the setup itself. Okay, so that you can again take this, apply it into your own trading after today's session. Okay. Now, what exactly is the setup? I'm gonna show you the model over here, and then of course we'll go into the live market, and then you can see how this is being applied, okay, into the actual market as well. Okay. Now this is a buy trade model. Now it's a bear drawing. I'll start to edit elements and explain to you so that you understand as well. Okay. Now this is a buy set. This is a buy setup model. Okay. Now what I mean by that is that if today you want to be buying into a market, you want to look for a buy signal, this is essentially what the criteria needs to be fulfilled. Okay, this is exactly what you need the market to develop before you can get a buy entry. Okay, so there are a couple of principles that I would touch on, and these principles are SMC related. If you are familiar with that, smart money concept, or AKA some traders will call it ICT, okay, which is very popular in the recent 1 or 2 years. But of course, we don't go into very complex stuff. We simplified the model itself, and this is basically what I call a one setup, right? One trade setup. Now, first element, when we want to buy, okay, we need to first identify a break of previous low, right? Which means the market, previously is pulling back or it's coming down, and then we have a previous low that gets broken. Okay, now once that gets broken, we also want to see a reversal back to the upside, right? So when we have a low broken, and then immediately the previous swing high gets broken as well, we can then classify this as what we call a liquidity sweep. Okay, let me just very quickly change this. Okay, so that's what we call a liquidity sweep, right? Which means that, aka, it's a fake break, right? Why is it a fake break? Because the market broke the low, but then very quickly reverses and went up and break that previous swing high. Okay, and when it breaks that previous swing high, we call this a break of structure. Okay, so this is the first two criteria that we need to see if we want to buy into the setup. We need a market to fake break a low, aka a liquidity sweep. Then the market needs to reverse, okay, and break and close above that previous high. Now, once we have this, the third conditions we want to see is, do we have a momentum push towards the outside, right? Because if we want to buy, we want to make sure that the market momentum is pushing higher, okay? So we need to see what we call a fair value gap. Okay, in a while I'll show you in the candlestick pattern what it is, right? But a fair value gap essentially is just telling us, right, there's a momentum pushing price higher. Okay, and that's what we want, because if we want to buy, we want to buy with the momentum. Okay, so that's the third condition. And the fourth condition is simply, waiting for a correction, waiting for a pullback, and then I'll be using the Fib 67 Fibonacci retracement as my entry point. The previous swing low, which is the 100% retracement, is my stop loss. And very quickly, the previous high, which is the 0% Fibonacci, is my take profit. Okay, now whenever we have a setup like that, the risk to reward ratio is always going to be on average 1:2. Okay, and talking about risk to reward ratio, this is important because today, if I'm looking to take a trade, I want to make sure that every risk I put in, I have a high possibility of making more than what I'm risking. Okay, so 1:2 risk to reward essentially just mean if I'm putting a 1% risk, if I lose, I'll lose 1%. If I win, I'm gonna win back on average 2%. Okay, now some trades we can actually extend the target, and go up for higher risk to reward ratio. We can take partial profits and management of trades, etc. But for today's part, we just keep things simple, right? We just have an entry, have a stop, have a take profit. The average risk to reward ratio is 1:2. Okay, now if you flip this, right? If you flip this, then that's going to be the sell setup, right? Today, if we want to sell, okay, naturally what we need to see is the first liquidity sweep, okay, and then a break of structure, and then we wait for the market to pull back to get involved in an entry. Okay, so you just need to flip the entire model. We want to have a liquidity sweep, okay, and then the market reverses very quickly, break that previous low, okay, and then starts to pull back. We can pull in our Fib, swing high to swing low. Around that 67% is where our entry is. Our stop is above. Our target is below. 1:2 risk to reward ratio. Okay, very simple, right? So this model itself, you can use it on a lower time frame. You can use it on a 15-minute. You can use it on an hourly. You can use it on a 4-hour time frame. But personally, I use this to trade the hourly time frame. Okay, so the model itself is to identify the setup on the hourly time frame, and then on the 4-hour time frame, I'm using it to establish the directional bias. Right. So very quickly, I'll show you. I'll jump straight into one of the potential setup over here, which we'll talk about. It's crude oil. Okay. So I'll share with you the higher time frame point of view first, right? So you can look at the entire process of the DSC framework. Okay. So the first step here is to establish our directional bias, right? When we look at an instrument, when we look at asset, do we want to buy? Do we want to sell? We need to establish the focus, right? And of course, depending on your horizon as well, are you looking at short term? Are you looking at mid term? Are you looking at investment point of view, right? Your bias may be different because the market moves up and down, right? So what you see on the screen over here, on the right top corner, the primary time frame you can see is H1 and H4. So H4 time frame, it's a bearish bias. On the H1 time frame, it's a bullish bias. Okay, aka what is telling you, higher time frame, the market is coming down, it's in a downtrend. But on the shorter time frame on the H1, price is pushing up, right? So it can either, number one, means that we are in a temporary pullback on the bearish trend, right? We're pulling back. Or number two, the bearish trend may have been concluding soon, and we are potentially reversing. Okay, so when you see some signals like that, that's what essentially you can, decipher. Okay. So if you take a look at the bottom left, right, what I have in terms of the analysis over here, as a conclusion, right, you can see the primary sequence is bearish because the higher time frame is still bearish. Okay, we are technically still in a bearish trend. But the expectation here is that price might be turning bullish, right? So what I've put in the analysis is that the analysis is telling me, yes, we're in a downtrend, but this downtrend may be ending soon. It might be turning bullish, right? So it's an early signal of a bullish market, right? So what's the trade plan over here? The trade plan is to wait for a retracement for a potential buy, okay? So if today you're looking at a 4-hour time frame perspective, you'll be waiting for this to pull back towards the 50% Fibonacci, and then we'll look to buy it up from there. Now, while we are waiting for this to pull back, okay, we can also consider taking a short-term, kind of like a retracement trade, right? We are expecting the market to pull back towards 59.95, which is where the 50% Fib is. We can consider to actually sell it. Right, and what I call this is a retracement, trading the retracement, right? So it's kind of a short-term thing, okay? So why is this whole analysis important? Because it's actually giving you the bias, it's giving you the focus on, looking at the direction. It's also giving you a context, right? Because today, if I want to be looking at the larger time frame context, I'll be interested only in the buy. But at the same time, I understand that the market may pull back, and therefore opening up a short-term opportunity for me to even consider selling it first. Okay, so that's what the 4-hour time frame provides. And if today I go down to the lower time frame, okay, we do have an opportunity here to look out for a sell setup. Okay, now this setup over here, you can see just now we went through, right? There's some similarity to it. The only difference here is we don't have a liquidity sweep, right? Okay, the model, what you want to see is a push up, a fake break, right, or what we call a liquidity sweep. The market comes back down, break a structure, pulls back, and then we sell it, right? You remember this model. Now what we have over here is pretty similar. The only difference is we don't have a liquidity sweep, right? We don't have a previous high here that broke. Okay, but everything else is there, right? We have this break of structure, we have the price coming down with momentum. While it's pulling back, if it comes back towards the 67, that becomes our sell entry. Okay, now where can we identify that momentum push, right? Just now at the very start, I talked about this term fair value gap, FVG, right? Now in technical perspective, right, what is the fair value gap? Is a 3-candle formation. Okay, so if you take a look at this here, we have this white candle, we have this huge momentum bearish candle, and then we have another small bearish candle. Okay, and then what you realize over here is that this first candle and the third candle did not overlap. There's this entire gap that is between the first and the third candle, right? The middle one is a huge bearish momentum candle. So when we have a situation like that with a candle pattern like that, this is what we call a fair value gap, right? So usually if you want to kind of like draw it out, okay, we're just going to use a rectangle tool, and then that's your fair value gap, right? So ideally, what we want to see is as we are pushing lower, okay, and our 67 Fibonacci, which is where our entry point is, ideally you want to have your fair value gap align with your 67 Fibonacci retracement entry. Okay, so when there's an alignment, it adds up to confluence. It gives this trade setup a higher probability. Right. So this trade setup here, how we can look into it, we do also have, if you stretch it further out, okay, we do have some liquidity sweep. Okay, based on the previous high here, but that's a little bit stretched out. Okay, but any case, that is one missing element in this entire setup. The other things are still there. Breaker structure is there. Fair value gap is there. As just pulling back, we'll look into the 67 as our entry. And then our stop loss will be at the top. Alright, and then I'll take profit to 0. Okay. So this one here, of course, depending on how specific you are in putting, in setting, the average risk to reward is about 1:2 because of, proportion wise. Okay. So crude oil over here, we're looking at this trade opportunity. Our entry point is around 64. Okay, our stop loss is at 64.85, and our take profit is around 62.440. Okay, 62.40. Now, can you go for further targets? You can of course go back to the higher time frame, and then look at the key level here, which is the expectation of price coming back down to 59.95, or you round a little bit, 60. You can set your secondary target at 60. Right, because if you're gonna put your take profit at 60, right, you can see your risk reward increases significantly to 1:4 point something, right? In fact, it's close to 1:5. Okay, so what you can do over here is you can have like take profit 1, you can have take profit 2, so target 1, target 2. If target 1 hits, you can take partial profits and then aim for target 2. Okay, so that's the first opportunity that you can look into for this week here right now, which is crude oil. Okay. Now the other one that I think is worth mentioning and looking out for is the S&P 500. Okay. Now the S&P 500 has been, experiencing some volatile movement, especially with Trump, and its policy in terms of like tariff. We did see the S&P actually dip quite a bit, right? In fact, it has dipped close to 20%, and then that triggers a bearish market. But from right now, what we're seeing, okay, is that there's a good possibility we are seeing some sort of a bounce, right? Now, the directional bias on the 50-minute, on the hourly, and the 4-hour, on the top right corner, you can see is bearish. No doubt we're in a bearish market trend. However, the expectation here is price might be turning. Okay, why would I say that? Is because we have this impulsive leg up after a drop. Okay, so kind of giving us an reverse signal, right? And the market is currently pulling back. Okay, so the key area that we want to keep an eye on is somewhere around 5,070 area. Okay, the 61% Fibonacci retracement. This would be a key area that we can potentially look to buy. Okay, so the trade plan here is to look for potential buy setup. Okay, now if I bring you to the lower time frame, okay, if I need to zoom out a little bit, what do we have over here? Okay, very similar buy setup model. We have the market didn't really break the low. Okay, kind of tested it a little bit, forming a little bit of a double bottom structure. Okay, we have this swing high. The market actually break and close above that, right? So that's a break of structure. The momentum is huge, right? You can see that huge bullish candle forming a very big fair value gap. Okay, so the elements are there. The market is currently pulling back, so we have swing low, swing high. 67% is where our entry point is. Our stop loss just below that swing low. Take profit, swing high, right? Risk reward 1:2. Okay, very straightforward and simple setup. Combined with the DSC framework, gives you that clarity. So what is the entry here? We can look at is somewhere around 5,058, right? Depending on how specific you want in terms of your entry point. But around that range, right? 5,060. That's your entry point. Your stop loss is around 4,840. Okay, and your take profit here, you can place it at 5,500, or round down a little bit, 5,495, right? You can look at this area. Now, S&P over here, same thing, right? If the higher time frame is suggesting that market would be turning bullish, we can have extended targets, right? We can expect the market to go higher from there, breaking this high. It can continue to go to test this high or even its previous all-time high, okay? So what you can do here, is also having a trade management perspective where you have multiple targets. All right, so you have take profit 1, which is here. Once it hits it, you might scale out of your position, maybe take about half the position out, or maybe a certain percentage like 20%. Leave the remaining. You can trail your stops, with extended targets, right? That's what you can do for the S&P 500. All good? Can follow through, right? Now there are other two setups here that I can talk about as well. The first one I think is worth keeping a close watch is the pound dollar. Okay, so if you take a look at this on the 4-hour chart, right, pound dollar is no doubt in an uptrend, right? So it's a bullish market, H4 bullish, H1 bullish. The sequence here is bullish, but the expectation is we are expecting price to make a pullback retracement. It may not necessarily be a reversal, but at least a retracement, right? Why? Because from an Elliott wave perspective, from this swing low to this swing high, we can obviously see a potential 5-wave development. May have completed, and therefore we can't expect a simple 3-wave pullback, right? Now what this means is that our trade plan here opens up the possibility we can look for a short-term sell. Now while the trend is bullish, we can still look for sell opportunity. Why? Because we are expecting the pullback, we are trading the pullback. We understand that we're going counter trend, we're looking at a retracement trade, we're not looking at a long-term perspective, right? So again, these are elements of context, right? So now, if today we have established the decision and trade plan to look for a sell, it doesn't mean that you just execute a sell trade immediately, right? You need to have a setup. You need to have a set of conditions so they can, follow your plan. You can be disciplined. You don't chase the market, and that's where we can go down to the lower time frame. Okay. Now this one here, the setup hasn't really been established, but I just want to bring your attention to it because it might establish maybe tomorrow or even Thursday. Okay, and that's the part where I want to share with you the setup first, right? Because you can then use it to trade it even if the signal isn't generated today. Okay, so what you see over here is we have few elements that are building up, right? You can see that this high, okay, this high has been tested, right? Some sort of a little double top. Okay, and then at this very moment, you can see that this low here is being tested as well, right? Potentially a break. Now this candle hasn't closed yet, but if today the candle is able to close below this low, what do we have, right? If the candle can close below this with momentum ideally, then we have a liquidity sweep, kind of a double top, break of this neckline, break of structure. What do? We wait for a pullback and then we sell it down. Okay, so that's the model. Okay, so you need to be very clear in terms of like the condition is set up. Okay, so again, this is not something you can set an order today. It's building, it's not completed, but I think it's worth noting because if this is going to develop, you might get the setup maybe closer towards like end of Wednesday going to Thursday, right? So this is something to note on GBP USD. Another one I think is worth noting is the Aussie dollar. Okay, pretty similar in terms of what it's doing. We have a huge momentum push to the upside. Direction wise, H4 bullish, H1 bullish, we're in an uptrend. However, we're kind of expecting a pullback, right? Again, the market will never move in one direction all the time. It tends to do some sort of pullback eventually, right? So right now we are expecting some sort of pullback, right? Again, whether is it going to come to 50% Fibonacci, we don't know, but at least some sort of pullback, right? So the expectation is for price to make a retracement, and therefore the trade plan this week is to look for short-term sell. Okay, we want to trade the retracement. Now, if you go to Aussie dollar over here, some of the setups are building in pretty nicely as well. Right, you have this little liquidity sweep, right, or what we call a double top. Okay, and we also have this break of structure, right, which means the neckline has been broken. Okay, I mean, depending on how specific you want to label that. Okay, so what this means is, of course, this would now be our temporary swing high. Okay, price is coming down. We technically don't have a very clean fair value gap. We have a little bit here, but it's not the cleanest, right? It's very, very small. Okay, it's a very, very small fair value gap, right? Which I probably don't want to annotate that right now. So what you again, want to also look for potential higher time frame is how big is the candle, right? Do we have that momentum move? Again, because if today we want to sell, we want to see momentum to the downside. If we don't get the momentum to the downside, then it's probably not a clear direction of us, right? So this is something to note. Even on GBP USD right now, we don't really have a fair value gap created. Okay. Compared to what? Compared to crude oil, you can see, fair value gap is there. S&P fair value gap is there. Right, very huge. So GBP USD and AUD USD is basically developing signals. Not really in confirmation yet. And that's what we call a watch list, right? You want to add it into a watch list so you can keep an eye on it and see how things are going to develop moving forward from here. Okay, so again, suppose this actually make a move lower and then starts to do some sort of a pullback. You can then start to put in your Fibonacci from swing high to swing low. 67 is where you're going to look to enter. Right, so pound dollar, Aussie dollar, these are the two things you can keep track on. Okay, worthy of noting. Okay, yeah, so these are the two ones that is still developing. The crude oil and the S&P, they are more or less ready, which means, you can place your pending orders. If price tags into our entry, then that would be a valid trade that we can, join in. Okay, so you can see I look at some other instruments, but at the moment, there isn't much of a kind of a setup that is really developing, right? But let me show you what I mean as well. Okay, this is gold, right? I think a lot of traders are very, very interested in trading gold. But you need to understand, it's not every day you're gonna get a signal in gold, right? Because again, depending on how time horizon, right? If today you are more of a swing trader, the current price is not where you want to be buying already, right? Because it has already moved quite a bit. We're kind of expecting some sort of a pullback retracement. You don't want to be buying at the very top. Okay, if you're a swing trader, your buy would likely be here. Your buy would likely be, when it's pulling back, right? That would be a much better area to be buying into gold. But if you're scalping it, right, then that's a different story, because then you're looking at intraday, things like that. Okay, but the point here I want to kind of address is that you might, as a swing trader, right, today if you're looking at H1, H4 time frame, you might want to consider expanding the instruments you're looking at, because if you're only looking at one or two instruments on a swing trade perspective, then you're going to be very bored, right? You're not going to get anything maybe for some period of time, and then there will be some trades during a certain period of time. Okay. So gold, right? From a swing trade perspective, it's bullish. I think nobody would, kind of disagree that it's a bullish market, right? It's hitting all-time high, but it's just basically not the right time to be buying. But at the same time, you don't want to just sell it because it's all-time high, because you can go higher, right? So at this moment here, you can see, the primary sequence is bullish on the top left. The expectation is, we expect a retracement, but the trade plan here is just being patient, right? This is what I have on a swing trade perspective, which means there's really nothing there that I can participate in on gold, at least for now. Alright, maybe second half of the week, while things are developing, it might change, right? We might present something, but at least for now, there isn't anything, right? This is at least from the swing trade, right? So I just want to show you some examples also, where not necessarily you're gonna get trades setups every day. Okay, but if you look at enough opportunities, enough pairs, enough instruments, you tend to get trade ideas. You tend to get trading opportunities quite regularly, right? The list I'm looking at here, if you kind of reference to that, typically a week you get about 2 to 3 setups, 2 to 3 trades. Sometimes a little bit more, sometimes a little bit less, but on average it's about 2 to 3 setups, 2 to 3 trades in a week. Okay. So as of today, you can see the two setups that I think is a little bit more ready is crude oil and S&P, and then GBP USD and AUD USD. Very, very high potential. They're building up into something, right? Let me just do a very quick second scan through. Yeah, I think that's generally about it, right? Any questions, put it into the chat. If not, I would also very quickly touch a little bit into intraday, right? 15-minute time frame, right? Which I think some of you might be interested in. Okay. So this technique in an intraday approach, it's not as complex, right? But it basically still carries the framework of DSC, right? You need the direction, you need setup, you need context. Okay. So in terms of direction over here, there are many different ways you can look at it. You can align it with a higher time frame. I'm using here, you can see basically M15 is bullish, H1 is bullish, I'm bullish. Okay, S&P 500, M15 is bearish, H1 is bearish, I'm bearish. Okay, so we're basically looking at the shorter time frame, right? And this one here intraday, basically you can trade the S&P and the gold. Okay, or you can add in NASDAQ, right? So you can swap out the S&P, you can include the NASDAQ into it. So that's the direction, very, very straightforward, right? You can use MAs as well. So if you look at, my chart here, we have 3 lines. Those are basically your 20 MA, 50 MA, and sorry, your 50 MA, your 100 MA, and then your 200 MA. Okay. So this one here, you basically just use 3 MAs, 50, 100, and 200. The colors obviously doesn't really matter. But the directional bias is being established as if today the trend, the 50, okay, is above the 100, the 100 is above the 200, we are bullish. Okay, if the opposite happens, right, where we have the 50 below the 100, 100 below the 200, then we are bearish. Okay, very, very straightforward, very mechanical. Okay, so if the MAs are like one on top of another, we're bullish. If the MAs are one below another, we're bearish. Okay, so that establishes your directional focus for the day. So I'll give you an example, right? XAU USD Go. On the 15-minute time frame, we are bullish bias, right? So we want to be buying. But it doesn't mean that you're just going to jump into the market and buy any other time, right? There are specific setups that we need to see, right? Again, we want to buy, but we need to see certain sets of conditions. Okay, so what's the conditions we require? You can see some marking here on the chart. Okay, we have the Asia market, we have the London market, and then right now we're in the New York market. Okay, if you're not familiar, you just go over to Forex Factory. You can easily search out, based on the current daylight saving zone, which time to which time is the London market and things like that, right? But to keep things simple for you, London market is essentially our 3 p.m. to about 5 p.m. New York market is going to be from 8 p.m. to about 10 p.m., right? It's about 2 hours time period, right? For this technique itself, you want to be only trading during the prime time zone, right? Which is London or New York, right? But obviously, New York will be a little bit more active, right? US market is a little bit more active. What I mean you want to only be trading during the prime time is basically your execution, right? Your setup needs to be within the session itself, right? If you don't get it set up in London, you don't get it set up in New York session, you don't trade, right? I'm going to give you this example. Today we're looking at gold here, we're bullish market, we want to buy. What is the setup that we need to see? Okay, we want to see a liquidity sweep first. We want to see some sort of a fake break, okay? So the fake break over here is we are using the previous session low or high, right? Depending on whether you're buying or selling. If you want to buy, you want to look at the previous session low. Can follow? If you want to be selling, you want to look at the previous session high, right? Because we want a fake break, right? Which means we want the market to come down, break the session low, and then kind of give us a reversal signal. Can follow that thought process? And then if you get a reversal signal, we're gonna be buying into that, and then our stop loss is at a previous low here, and then we'll just put a 1:2 risk to reward ratio. Okay, and all this needs to happen within the prime time, right? So if today we are trading the US market here, we need to be looking at the setup occurring between 8 p.m. to 10 p.m. If it occurs before, it doesn't count. If it occurs after 10 p.m., it doesn't count. Okay, I'll just show you the S&P 500 over here. Okay, if you kind of backtrack a little bit. Okay, this was today, just before the London market opens, right? So what do we have? We have the MAs below one another, so it's a bearish bias. We're looking to sell. If today we want to look to sell, we want to see a previous session high gets taken out, which is what we get. Okay, so that's what we call a liquidity sweep, but we don't get it right after. Okay, what we need is a reversal signal. Okay, so London opens, we have this bearish candle. That's good enough, right? And that's what we call a reversal signal. We'll put our entry sell stop just below that candle. Our stop loss would just be above. We just simply aim for a 1:2 risk reward ratio. Right? If the next candle opens and it tags below, we get involved in the trade, right? Then we have our stop, we have our target, and then we just let it run. Okay, so this is where we are right now. And follow? Now it's a pretty mechanical trade, which means that you generally don't need to manage it too much. But obviously, you know what you can do is if today price starts to go towards your target, you know, maybe halfway through, you can consider shift stops to break even and things like that. You can do some minor kind of trade management, right? But the whole idea here is to let the risk reward ratio play out. Okay. Now, why this is important? Because if today you have a 1:2 risk reward ratio, okay, what this means is that for every dollar you risk, you potentially make $2, right? So if today your hit rate is just 50%, which is not too bad, right? I mean, half of the time you get it right, half the time you get it wrong. But if you have a risk reward of 1:2, half the time you lose, let's say you lose 5 trade, you're gonna lose $5. But the next 5 trade, if you win it, half the time, you're gonna make $10, right? And then net off, you're still gonna be profitable $5, right? So risk reward ratio is very, very important, right? A lot of times traders just focus on the hit rate itself. But I think today, you know, you don't need to go for very high hit rate. You just need to go for about like 55 to 60% win rate with an average 1:2. Right? And if you kind of calculate the math behind it, it's a very, very solid kind of expectancy, right? Very, very solid kind of profitability. Okay. Yeah, so that's what we have, right? So I'm kind of covering a little bit. Let me just put this back as a track. Okay. Yeah, so you know what we cover over here so far is some swing trade opportunity on the S&P and the crude oil. Okay, and of course, things that are worth noting: GBP USD and AUD USD. Right, and then at the same time, the short-term setup here as well. Okay, or I would say short-term strategy. S&P 500, as well as gold. Right, I think gold here has a good opportunity as well because today, if you can spike down and then next candle spike it back up, we might get that intraday opportunity to go for it. Okay, so basically, if you're interested in this intraday, you just need to spend about 2 hours a day, right? Whether you're looking at New York or whether you're looking at London. I mean, if you're looking at both, then that's like 2 hours, 2 hours, right? If you only want to trade a New York session, then that's essentially just 2 hours, right? Or slightly less than that, right? Because if you have a little bit of experience, you can actually start preempt or anticipate whether you're gonna get something that day. Okay, I mean, right now where the current price is to where this low is pretty close, right? So there's a high chance you might get something, and therefore you want to pay a little bit more attention. Certain days, the odds are pretty low, right? Like this one here, you can see this is like last session, Monday. Okay, when the London market is here, and then the New York market opens is here. If you want to buy, you need to wait for this to come down, tag this low, and then go up. Very unlikely, right? Which means you probably don't need to spend like the entire 2 hours in front of it. If you assess the situation, you say that, okay, unlikely you're gonna get something, then you can just, you know, get a day off earlier and, you know, come back another day. Okay. So that's how the strategy works. Good. Cool. Any question? Any question? Okay. Any questions you have, put it into the chat box. Okay. So far, no question. All good. Okay, good. Yeah. So if there's no questions, hopefully the session has been clear. Giving you guys some potential signals to be looking out for, and then of course more importantly, I think it's not just a signal, but the approach and the technique, right? The strategy behind it, so that it can actually apply. Pound Aussie. Okay, just see one question coming in. Okay, this is my analysis on Pound Australia. Okay. Now if you look at if I zoom out, right, you can look at the overall sequence, right? The overall trend is bullish. However, the expectation here is that we might actually be turning bearish soon. Okay. So what this means is that initially we are in a bull market, but with this recent push and potentially this retracement here, we might start to see a trend reversal. Okay, that's what I'm looking at. So of course, the invalidation level is going to be this swing high. The market needs to be below that swing high in order for us to be looking at a reversal down. Okay. Now the key area here that we're looking at is the 50% Fibonacci. Okay, so we have this push down. If we can get a decent correction towards the 50% mark, this is where we can look to sell it. Okay, but right now the trade plan you can see over here, be patient, wait for a pullback. Okay, so the idea is what I want to see here is for this to pull back, and then as it comes into the 50% mark, I want to see a setup to sell it. Okay, so I want to see a fake break, a liquidity sweep. I want to see a break of structure. I want to see some sort of a pullback, and then that will be my entry model to take the sell trade. Okay, so the setup is, I want to see that setup in the key area, right? A point of interest. I don't want to be looking at setup everywhere. I only look for a setup when price enters a key area. Okay, so this area here for Pound Australia will be around that 2.1175. Okay, 2.1175. Got it? Okay, hopefully that answers your question. Okay, on Pound Australia. Any other questions? Any other instruments? Okay, all good. Right, so if all is good, that's about it for today. Hopefully again it's helpful. Okay, yeah, so this is something that will be running at least every Tuesday for now. Yeah, if you know would like to join in, just take note of the timing, right? We'll be starting around 8 p.m. For next Tuesday as well. Okay. So yep, that's all. We'll end off the stream over here, and all the best to your trading for this week. And I'll see you guys in next week's session.